Hi everyone, this is about taxes, and of course you all know that the new tax law came into effect December 22nd, and the big question is, what is this going to do for you as the home seller? How is it going to affect you? And more importantly, how is it going to affect all those buyers out there? What's their reaction going to be to it? So stick around and we'll get those answers to those two main questions for you. Hi everybody, this is Kiwi of the Coast, your luxury real estate specialist, helping you maximize and sell the value of your coastal home. Now, if you're new to the channel, don't forget to subscribe. Now, of course, I have to say, consult your tax advisor or your tax accountant with all of these issues, but there are two main points that I want to cover. The first one is the interest deduction and how that affects people right now. So, as a buyer, we all know that with the new law, we're only going to be able to deduct interest on a $750,000 mortgage, not a $1 million mortgage. So let's just see in practical terms what that means to the average buyer. How much deduction has he lost? So let's do the math real quick, and hopefully I can do this. $250,000 is the difference. Let's assume 3% is the deductible interest, give or take. That's about $7,500 a year. If you're in about a 33% tax bracket, that means about $2,500 per year in lost deduction. Now, for the average buyer in the luxury market that we're covering, that isn't too bad. My guess is that the savings for people with corporations and self-employed is more than going to offset that $250,000, or beg your pardon, $2,500 in lost savings. So not too worried about that million going to $750,000. Next item is the deductibility of those property taxes. Now, we were all lucky before because guess what? We could deduct all our property taxes against our personal income tax, and that has now changed to $10,000 max. Now, my point is, how does this affect buyers? Well, obviously, they're going to be looking at the deductibility being less than what it was before in real dollar terms. But let's face it, people that are buying luxury homes in this marketplace have got to pay the higher property taxes anyway. The prices are higher. And so my feeling is the deductibility down to $10,000 won't be as big an impact as people think, especially if business is going to increase and people's taxes, especially if they're self-employed, as I mentioned before, is going to be leaving more money in their pocket. So are we really worried about that property tax deduction? Perhaps not as much as many people are thinking right now. So hang on your hats, I guess we'll wait and see. Now, if there's a win out there, is the fact that our group, the NAR, the National Association of Realtors, was very successful in retaining the 2 in 5 rule. Ask, what's the 2 in 5 rule? Well, that's when you're the owner of your principal residence for 2 of the last 5 years, then you can take, if you're married, $500,000 tax-free, or if you're single, $250,000 tax-free. So that is retained. We were looking at perhaps that changing to 5 in the last 8 years, which I think would have had a significant impact for people moving and changing more rapidly. So the good news, and that's the snippet here, the good news and the takeaway is that we can now, 2 of the last 5 years, retain that tax-free gain of $500 or $250. Hey, that's good news for us.
Now it's time for the Kiwi Squeeze.
This is Kiwi Squeeze time. This is where I want the juice. Tell me, please tell me what you think is going to happen to the buyers and sellers out there with this new tax law. I want, to find out what your tax advisors are thinking and what are they telling you and what are your experiences. So do share and please leave them down in the comments section below. I can't wait to respond. All right, guys, continue your real estate education right here. Click on the videos. We've got a great series. You're going to sell your home for more in less time. I'm going to help you do it. See you in the next video.